back to Microstructure Exchange. Thanks to all of you who submitted your papers to the fall series, and thank to all of you who helped us with reviews of those papers. The reviewers picked 7 studies that we will have presented during the fall series. And today's the first one, and then the second one is next week. So we're doing 2 back-to-back seminars to catch up a little bit, given that we're starting a bit late. But then after the second one, we will go back to our usual bi-weekly schedule. So don't be surprised that you will get an email from us on Thursday about next week's seminar. So today, we are very excited to have Mao Ye with a very interesting paper on how firms should be setting their prices given the microstructure effects. Mao is telling us that he is fine with people raising their hands at any time to ask questions. So please do as soon as you get one. And also there's the chat function that's enabled. If you have a shorter question that could be easily put in the chat, please use that as well. Mao, thank you so much for your time, and please go ahead.
Oh, can you see my slides?
Yes.
Okay, let me full screen slideshow. Okay, you can still see my screen, right? Full screen, right?
Yep.
Okay, great. First of all, thank you very much to give me the opportunity to present this paper. It's so glad to see all you guys. So this is joint work with Sida Li, who is a job market candidate on this year. He has a very nice paper, not this paper, on ETFs. I encourage you guys to give him a very serious consideration. So let's ask a simple question. So lots of people always ask me questions. Suppose you meet a CEO, let's say Jeff Bezos. What are you going to tell him? So here is one graph I want to show you guys. So for a firm, either through IPO or through splits or reverse splits, you actually change your nominal price. And then you look at this interesting graph. First pattern I want to remind you is like it's U-shaped. So either very low price or very high price is bad. So later I will try to convince you, it's not by coincidence. It's because of there are 2 frictions. For example, suppose you're a firm, you can choose to be very low price. Let's say some firms have $2. And because in the United States, so we have uniform tick size of 1 cent. So that means 1 cent of $2 stock is 50 basis points. So that means, the price might be too low. The percent bid-ask spread here at this end, this is nominal price, $1 to $5. The percentage bid-ask spread is very high because they suffer from tick size constraint. For example, if you split from like $4 stocks to $2 stocks, your bid-ask spread will not reduce because you suffer from tick size constraint, but your percentage bid-ask spread increases. So now, then the question is like, since there are tick size constraint, should we go very high price? Wait, there's another constraint, which we call lot size constraint. Why? Because to establish a national best bid and offer, you need to display at a minimum of 100 shares. So 100 shares of $2,000 stocks is $200,000. So in modern market, that's a big money. And suppose market maker posts $200,000 on the book, the large adverse selection risk for market makers actually also reduce liquidity. So in this case, like Jeff Bezos, actually, he should split their stocks, his stocks. So in this case, stocks improves liquidity. So what are the research questions? The first question is, what is the optimal price? Second is, which stock characteristics affect the optimal price? So here you can see another pattern. It's like, it seems like large stocks should have a higher optimal price, but it's not by coincidence. Later, I will explain to you why. So here's main findings. So the main idea of this paper is like, we find a very interesting 2-tick rule. So optimal price of a firm depends on volatility, dollar volume. And if it's talk about different countries, it also depends on tick and lot size regimes. But in the United States, let's say US regimes, all firms achieve their optimal price when their nominal bid-ask spread is 2 ticks. Why? Here's the simple intuition. It's because the friction from tick size is 1 cent. You should adjust your price to the extent the contribution from lot size is also 1 cent. So that means 2 tick rule. Okay. But then suppose some firms are not at the best price. How can they achieve that? We propose a simple formula, which is only thing you need to know is your current bid-ask spread. Use your current bid-ask spread divided by tick size minus 1. That's your split ratio. So it's a model. We start with a model, but later we also have like empirics. So our empirics actually can show our model parsimonious 3-factor model of liquidity can explain more than 80% of cross-sectional variation in liquidity. And it can also explain 61% cross-sectional variation in stock prices. And more interestingly, some splits are correct, some splits are wrong. We show stock splits increase liquidity if they move bid-ask spread closer to 2 ticks. And also, there's a literature document like the split announcement return. We find at least in current market, liquidity channel explain at least 1/3 of split announcement returns. And later we will talk about change, tick, and lot sizes. And because I see many like of my European friends here, I will also talk about uniform and proportional tick and lot sizes. So what is our model? So we have 3-stage model. We have 5 types of players. So at stage 0, a regulator choose lot size, let's call it L, and also choose tick size, let's call it delta. It can be either uniform or proportional. And at the stage 1, a firm with value V chooses its share price H. So H, it's a share price P. So we think about that as market cap. And V divided by P is shares outstanding. So what does the firm do? The firm aims to maximize the expected, minimize the expected trading cost for its traders. Or you can consider the firm want to maximize its liquidity at the time either through split or IPO. And I see John Sing is here. And after that, stage 2 is something similar to your model. It's like there's a market maker set competitive bid-ask spread, ST. And ST is like it's continuous time. So the firm initial value is V. That's at time 0. But it can either jump up or down. It evolves as a compound Poisson process. So intensity of the value jump is lambda J, the same as your model. And the size of jump here is in percent. It's either sigma VT or minus sigma VT. And the market maker choose ST, given PT, L, and delta. And informed trader aim to add the select market maker after value jumps. And the investors think of them as liquidity traders. They arrive with intensity lambda I, each of whom have inelastic need to buy or sell VT. Okay. So then let's go back to a bullish Crampton thing. So what's the difference? So in bullish Crampton thing, it's it does not have the regulator, the style in our model. So we can consider it's a special case when the regulator and the firm make suboptimal choices. For example, at stage 1, I think the regulator choose continuous price and discrete lot. So it's 1 share. And at stage 1, firm choose P equal to V. So now let's think about this V as market cap or something like that. Okay. So then the lot size is binding, and traders and market makers cannot further divide their demand into smaller units. And then stage 2, I will show you an example of BCS under continuous price, discrete lot of 1 share, and P is equal to V. So here's the roadmap. So first we talk about the firm's decision. So firm choose optimal P given tick and lot sizes. And I will start with BCS with continuous price, discrete lot. Okay, and later I will talk about the regulator. So what is BCS? So I summarize that. I think most of you guys know that, but I summarize that using like a 1 figure. Okay, so let's say during normal times, an investor arrives. In this case, the competitor market maker makes money. So this is a profit from providing liquidity to investors. So the profit is S/2. That's good news. But And sometimes the value jump. I mean, whether it's public news, private news, I mean, it's more general in our model. It's like, but the solution is the same. It's like, then the informed trader adverse select market maker. Okay, so, and then that's the loss of being adversely selected. So then, so what is the equilibrium bid-ask spread in BCS? So equalize the profit and loss. So this is a solution in BCS. Okay, this is ST BCS. Okay, so now let's add another player, the firm. So firm can choose the optimal nominal price through H for one splits. So now we introduce actually two variables, but they're equivalent. The first one is P. Think about that as P0. That's the initial public offering price, or it's the price exactly after split. So now the one share in BCS now become H shares. Okay, so what do the firm do? Firm try to minimize the expected transaction cost, the per unit time, at the time of the decision. Basically, it's like this is something like a proportional spread. Okay, it's ST divided by PT and multiplied by volume. So VOL is the dollar trading volume. So what does investors do? Investors aims to minimize transaction cost given PT. Remember, this is PT because price evolves after IPO. Investors need to minimize transaction costs at any time. So what's their decision? Actually, decision is not that difficult in our model. So it's a parsimonious model, holding liquidity demand fixed. The investor now in their model need to trade H shares. And then the choice actually is it's a choice. How do you slice and dice the demand of H shares? So let me give you two extreme strategy. Number one is like still trade like in BCS. It's like I threw all the H shares all at once. That's one example. The other one is like I divided my shares into H China orders of one share each. Here, lot size is still one, just the price change. And then the competitor market maker choose ST and a number of shares to display. So it's spread and depth. And the informed trader is a pretty simple strategy. It's like adverse select market maker. So what's the optimal strategy? So let me show you an animation. Optimal strategy actually looks like this. Slice and dice to the minimum lot. So the market maker maintains one lot, which is the minimum at an MBBO. Why? Because one lot depth minimizes the adverse selection risk. But then you say, okay, the investor need to trade a lot. How can they realize large demand? It's like they quickly refill the one lot once the previous lot is consumed. So in this case, the informed trader can pick off only one lot. So if firm chooses a low price or the continued price, that's actually good for the firm. Why? It's because smaller dollar lot size reduces the loss of the market makers. So on the continuous price, they should go to very low price. And uninformed traders slice and dice their demand into one lot orders. So the trading intensity is the same as BCS, not I, VT, but now it's expressed as PT multiplied by H, but their demand is still the same. So when an uninformed trader arrives, market maker is happy because market maker make money. Informed trader always, when there's a value jump, when they have information advantage, they adverse select the market maker. So, but if you reduce the lot size, the market maker's loss actually becomes smaller. This one actually gets quite strong empirical support. We find 87.5% of trades is exactly one lot, as long as the bid-ask spread is not constrained by one tick. So that means if you have like a more than one tick bid-ask spread, the depth is almost always equal to one lot. Okay, so what's the equilibrium bid-ask spread? So equilibrium bid-ask spread equalize these two numbers. And this one, I present that in percentage spread because it's more convenient. Later, I will show the bid-ask spread. So if you look at the bid-ask spread, compare that with BCS, the only difference is this H. It's split reduce percentage beta spread. Why? Because split reduce the adverse selection risk of the market maker on the continuous price. So on the continuous price, then we have a very funny prediction, but later I will explain you why. It's not. It's like firm should split to minimum possible price. But more realistically, when tick size is not zero, that's a completely different story. But now let me introduce the first proposition in our model. We call that a square rule. So now it's interesting. Let's look at the beta spread. So if you split, the beta spread will change at the square of the split ratio. So how can we calculate that? So this is the beta spread. So this is the percentage spread multiplied by price. So this number. And then let's multiply PT on both here and here. And then the denominator is the volume. And then we find like beta spread increase quadratically with price. Why? If you increase the price, let's say PT times, mechanically the beta spread will increase to make the percentage spread stay the same. Okay, so that's a mechanical change, a PT time mechanical change. But the other PT time comes from increased adverse selection risk. So that's the reason spread on the continuous price on the BCS or framework, it's a quadratic function of price. So, and the prediction later we will test that. It's like the beta spread in continuous price is proportional to the price of PT, and it's proportional to volatility, and it's inverse proportional to dollar trading volume. Okay, so now let's have a more realistic case. By the way, any question? Okay, if there's no question, I will go to a more realistic case. So let's first talk about US regime and later talk about European regime. So let's impose a discrete price. So what does a discrete price mean? Actually, it's pretty straightforward. So this is a beta spread in the previous section. The tick size actually impose some constraints for market maker to quote. And the market maker need to widen the beta spread. So they cannot make that more tight, otherwise they lose money. So in this case, they widen to like a $5.01 bid and $5.03 ask. But this is just one example. It depends on the random variable, how the random variable move. So let's look at the same continuous price beta spread. And let's say the pricing grid looks like this. And then the beta spread becomes 3 cents. So our model shows the average widening effect actually is exactly 1 tick. So what does that mean? That means what's the difference between continuous price beta spread and the discrete price beta spread? The difference is on average expectation is 1 tick. What does that mean? That means if you look at the beta spread of a firm, there are 2 parts. The first part is law-driven part. The other part is tick-driven part. Tick-driven part is always 1 cent. So SL, now let's call SL is law-driven spread. S delta is tick-driven spread. So split reduce law-driven spread, as I just showed you in the previous section, following the square rule. But the tick-driven spread cannot be reduced. And actually, because tick-driven spread in nominal sense is always 1 tick, if you split, that's bad news because the proportional spread would increase. And now this is a key proposition of the paper, which is proposition 4. I will move slowly here. So we have the same optimal beta spread, but different firms achieve this optimal beta spread at a different optimal price. So the firm try to minimize expectation of transaction cost. So it has 2 parts. So this part is the tick-driven part, a law-driven part. This part is tick-driven part. So plus some constant. And the sum of this part is greater than like 2 multiplied by the square root of the multiple. And it holds inequality only when these 2 parts equal. So it's only when the tick-driven spread is equal to log-driven spread. So that means that all firms maximize liquidity when bid-ask spread are 2 ticks. But firms achieve this different optimal price at different optimal price, or optimal spread at a different multiple price. If you have stock with high volatility, you have lower volatility or more dollar trading volume, or you can consider V as market cap or large market cap. You should choose higher prices. Okay, so heterogeneous optimal price leads to the same optimal spread. Again, because the fundamental trade-off is like when a firm sets optimal price, they need to make the tick-driven friction equal to the log-driven friction. Okay, but then let's say, okay, let's talk with Jeff Bezos. Oh, you need to split your stock because the price is too high. So, Pete, you have a question?
This may not be the right time to ask it, but if you look at this from the perspective of the government, should the government cut both the tick size and the lot size, make them infinitesimally small? If they're trying to maximize the utility of traders?
Yeah. Yes. They might have a consideration outside our model, but in this model, that supports your paper of perfect continuous market under our framework. Yes, your basic idea of the perfect continuous market actually is we support your argument. Yes, under this model. And after I address question from Peter, let's go back to Jeff Bezos. Okay. So suppose now Jeff Bezos is like sitting in front of me. Oh, how can our firm split? If he listened to me, should he calibrate all the models, the structural estimation? What is sigma? What is VT? What is lambda I, lambda J? The answer actually is surprising, but he does not need to do that. Why? Because the optimal split ratio, the only sufficient statistic he need to know is his current bid-ask spread. So why? Because current, like Amazon trade at a ridiculous high bid-ask spread. It's $1.4. It's like, even given the price, it's still very high bid-ask spread. So then suppose he split. Okay, so the majority part of that bid-ask spread is the log-driven part. If Bezos split, the log-driven part will decrease at the rate of h squared. The log-driven part does not change. And let's set this number equal to 2 ticks. That's the split ratio. Bid-ask spread minus 1 tick divided by 1 tick. Now let's give you one example, just using current example. Okay. So Amazon proportional spread, surprisingly, is 6 times higher than Microsoft. I don't think their firm's fundamentals are that different. So Amazon has like $3,305. The bid-ask spread is $1.5. And Microsoft is $255 stock price. And the bid-ask spread is 2 ticks. So if Amazon do a 13-for-1 split, so the spread will change, actually, the nominal price will change to like Microsoft. And the bid-ask spread will also be identical to Microsoft. So basically, it's like Amazon now should do like a 13-for-1 split. Or if they believe my model more seriously, the optimal ratio actually is like a 12.3 to 1 split. So if you look at these firms at fundamental value, okay, it just follows. Okay. So now let's show, I just give you one anecdotal evidence. Let's show you the empirical evidence. So we have 2 types of empirical evidence. First one is like, I think a key question in our field is to explain bid-ask spread. And we propose a 3-factor model of liquidity using 3 variables in our paper. And it explains more than 80% of cross-sectional variation. So there are 3 variables. Number 1 is price. Okay, if you look at this variable is price. So the coefficient before price is 2. And here is dollar volume. So you can also consider market cap, VT as market cap, but finally we find the dollar volume is way more important. And also the third one is volatility. Volatility has 2 parts. Like it's a mix of size of jump and frequency of jump. So 80%. And also stock price. We can explain like 61% of cross-section variation with only two variables, dollar volume and volatility. So this is direct test. So this is just a functional form of our model. So beta spread minus 1. If you look at here, it's like the R square is like it's on average is more than 80%, and the coefficient before the price is 2. So that means beta spread minus 1 cent increase quadratically with price. So the data fits model not only qualitatively but not quantitatively. Okay, so there's one possibility. Let me explain. Let me be frank. This does not fit well, like many years ago. Okay, still the direction is correct. I think one possibility is like lots of people ask me what is like a machine learning, big data, something like that. I think our field actually is on the frontier of machine learning and big data. It's because think about it. Lots of these decisions actually are made by machines. So we guess probably it's like machines that making liquidity probably use models similar to this model. They are more parameters. So that's the reason it's like our field is like a perfect place to study like the behavior of machines. Okay, so now let's compare with previous benchmarks. So lots of I run these regressions in my other papers. So two benchmarks is Madeleine's paper and Hans Stoll's like presidential address about frictions. So our model is like we have a series-driven 3 factors. The R square at the end of our sample period actually it's increase over time. It's 0.84. Madeleine have 4 variables or 4 factors. The R square is 0.61. And Stoll, if you run his regression nowadays, it's also 0.61. So why our model outperform? Okay, first I show outperform. Later, let me show you why. The first one actually is a surprising simple trick. It's like you need to, the dependent variable should not be beta spread or even percentage spread. Is beta spread minus 1. Why? Because there's 1 cent, which is mechanical. You need to minus that 1 cent. Okay, and also if you run Hans Stoll's regression in traditional form, you actually assume price has monotonic relationship with liquidity. Our model captures the U-shaped relationship. Actually, if you simply minus their beta spread by 1, you got similar R square. Actually, it's pretty close. So that's the first part. Second part is like when I run the regression, I control market cap. But here is like market cap does not have as much value. If you show here, it's like if you control dollar volume, then you control market cap. The value is tiny. But if you control market cap, you don't control volume, the change will be huge. So I guess it's like everybody has a right intuition. Large stocks are more liquid. But my point is like large stock matters. It's only because they have larger trading volume. So our model actually predicts if you have like small stocks with lots of volume, it's similar to a large stocks with limited volume. So that's the reason we can outperform previous benchmark. And the cross-sectional test on price is more interesting because it's also related to behavioral finance literature. So there's behavioral finance literature to explain why firm choose a specific price. And we have model with only 2 variables, dollar volume and volatility. That explains 61% of cross-sectional variation in stock prices. Okay, and we run this model very seriously. We use the same functional form. These 2 variables explain 61%. There's no fixed effect, by the way. 61% cross-sectional variation. That's higher explanatory power. And also it addresses the puzzle in behavioral finance literature. For example, Baker, Greenwood, and Wugler, they write a paper saying nominal price is a consequence of K. So they have explanatory power. But there's one thing they cannot explain. It's like they claim a somewhat unexpected result is like volatile firms have a greater, not lesser, propensity to manage price downward. So that means that stocks with high volatility, actually they have low price, which is surprising for them. Here I can provide two interpretations, which is two sides of the same coin using market microstructure. Let's think about it. There's increasing volatility. That means adverse selection risk increases. Okay, so you can understand that using lot size constraint. A volatile firms, you should reduce the loss of your market maker. So you should reduce the price to decrease the lot size constraint. So that's one understanding. Okay, the other way is the opposite, but it leads to the same conclusion. It's like we know like volatility increases, proportional bid-ask spread increase. That means when you choose the same price, you are much less likely to be tick size constrained. So firm should reduce the price because you face less tick size constraint. So both from lot size constraint or tick size constraint, volatile firms should choose lower price. There's another paper written by Dick Thaler and his co-author Ronnie McKenney and their co-authors. It's like so they find two things. It's like the first finding is like you cannot explain nominal price. That's their main claim. And then what explains the nominal price? Social norm. That's their story. Firms choose similar price with their industry peers and with their size peers. Okay, so here I run volume, but it's similar like market cap. Yeah, yes, yeah, right. If you control for industry fixed effect or volume, yeah, that explains 52% cross-sectional variation. But our interpretation actually is like why there's industry fixed effect. Actually, firms in the same industry, their volatility are more or less similar. So if you control for volatility, okay, if you control and you will find, even if you add industry fixed effect, the explanatory power is minor, it's 0.01. We understand usually like fixed effects are very, very powerful. It's like, but here it's like after you control volatility, industry fixed effect, the effect almost gone. And also why large firms choose higher price. Our interpretation is like large firms have high volume. So based on our two-factor model, they should choose a high price. So there might be some like peer effects or behavior interpretation, but using a market microstructure two-factor model, you can explain 61% of cross-section variation. Okay, so now let's go to a more exciting money part. It's like, suppose firm manage their price, what can they gain from that? Yes, we show a lot. So first thing is like, okay, our model have a predicted bid-ask spread change. That's when they announce the split or reverse split. Okay, and there's a realized bid-ask spread change. Okay, so then there's R. Why we use R is like because some splits are right, some spread are wrong. Okay, and then we have a sample of US common stock splits announcement from 2003, which is after decimalization, to 2016. And we exclude stock splits less than 1.25 to 1. So then we have 1,264 stock split. Okay. And you run this regression. So the dependent variable is the realized proportional spread change. And R is predicted spread change. And we find it's like 1 basis point increase in predicted spread change using our model leads to 0.97 basis point change in spread in the data. This is the first finding. The second finding is interesting. It's like most firms do that correctly. So average predicted spread change is as huge. Actually, it's a 15.22 basis point after split. So majority of stock splits are correct. So they reduce proportional spreads. And then if you look at the return, because we know liquidity matters for asset prices, and this is like the correct splits, and this is the wrong splits. Okay, and So, and you can look at that. It's like the correct splits have a higher return than the wrong splits. On average, splits are good news. So there's increase in stock price, but correct splits have 1.2% more increase, okay, in return. And now let's take that seriously. Let's run a car regression control for all the factors. And then we run, this is R. Again, this is not changing liquidity. This is expected changing liquidity at the announcement date. So here is a sensitivity. We find it's like 1 basis point predicted spread change increase will reduce the announcement return by 6.25 basis points. And the correct splits ratios can explain 95 basis points of the overall split announcement return of 272 basis points. So there are lots of interpretation why split matters. We show it's like liquidity, the correct split actually provide interpretation. And the back of envelope calculation is like a median US stock value would decrease by 69 basis points if it moves to its optimal price. So this is empirical. So before I move ahead, any question?
Looks like Bjorn started something in the chat that went very lively for a few minutes. Bjorn, would you like to ask your question now?
Okay, I was asking in the chat. So the price discreteness can be rationalized in that you want to maintain time priority. And I was trying to think about if there is a similar motivation for having discrete sizes. I can't think of why you would want that. Do you have an idea?
Yeah, it's hard. Yeah, I agree. Yeah. You mean the point? Yeah. So actually, I will show you later. Actually, we propose actually to decrease the lot size. Actually, it matters a lot. And later, we have other papers showing it also especially matters a lot for retail traders. Because now in the United States, think about Robinhood. It's like Robinhood match the round lot price. But what the order flow they get is all lots. So one of their business model, we believe, is like for Amazon, it's not that hard to beat their bid-ask spread. Providing price improvement for 1 share or 2 shares, it's like it's easy. It's because everything is defined. NVBO is defined over round lot prices. But I agree with you. Now, actually, in retail traders, it's like retail brokers also allow you to trade fraction of shares. So, but the issue is that yes, you can trade a fraction of shares, but actually goes back to your point. It's like you can trade it, but then the best price is defined over round lots. For Amazon, it's like the benchmark is $300,000, and they like Robinhood and some brokers, they are happy. It's like to beat for high price stocks, it's extremely easy to improve the price because you do not. I agree with you. You do not compare apple with apples. You compare price of 100 shares with price of a share, or even fraction of the share. Yeah, I agree with you. But if anyone knows there's any rationale to set lot size, please like raise your hand or leave that on the chat. We search aggressively. Yeah.
So if you're the SEC and you're thinking about tick and lot size, is it an implication of what you just said that by having a kind of big tick and a big lot size that makes the optimal trade size quite large, you're kind of discriminating against retail traders that want to trade fractions of the minimum lot size and benefiting the purchasers of order flow or the sellers of order flow at the expense of their retail customers?
Yes. So that's the reason. It's like there's a proposal to reduce lot size. The people who are against the most are the type of guys you just mentioned. The funny thing about it is like it's Citadel. Citadel have also market making arm, also have like internalization. So these two parts actually have slightly different opinions. That's a long story. We talk with them. But okay. So then it goes back to any other question?
Mao, maybe it makes sense to finish and then kind of get into a big discussion.
Okay, great. Now let's go back to Pete's point about the regulator. Okay, so first let's talk about US regulator. Let's say we have uniform tick and loss sizes. So there's an initiative. It does not went permanent, but it happens. If it went permanent, that's a different story. This is a story I want to show you. Suppose you're a firm. Let's say you, as regulator, permanently increase your tick size by 5 times. What should you do? Surprisingly, what you do is like 1 for square root of 5 reverse split. So originally, let me be frank. Originally, I thought it's like we should perfectly neutralize that. I should do 1 to 5 splits. But actually, after we show in our model, actually, surprisingly, that's also a bad decision. Why? Because if you have 1 to 5, you reduce the tick size, but you dramatically increase your loss size. If you look at this formula, the effect is the same. Actually, it's like reduce the tick size by 5 times, increase loss size by 5 times. It's the same as the reverse. It's like so what's the optimal ratio? It's like I call that square root rule. It's like you do 1 for square root of 5 reverse split. Under this new regime, contribution from tick size is still equal to contribution from loss size. The best optimal spread is still 2 ticks, but now it becomes 3 cents. And the liquidity deteriorates by a factor of square root of 5. So this is 5, or square root of 5. So if you decrease the loss size by 100 times, then firms should permanently, I say, firms should respond by 1 for 10 reverse split. Okay, so that means like bid-ask spread will reduce by 10 times. So the first best policy goes back to Pete's paper is continuous tick size and loss sizes. Okay, so this is US regime. Let's talk about it. There's some, I know in many European countries, they have proportional tick size or something similar. And proportional loss size is rare, but there's something have similar flavor. Okay, so here's one result. Here's the interesting thing. It's like, it's very hard to compare directly for proportional and uniform tick and loss sizes. Let's start with an interesting benchmark. Suppose we, let's say US want to change from uniform to proportional. Then what's the benchmark? Okay, proportional, you need to define that on percent. What we show you is like, okay, you cannot using any existing stock as benchmark. Why? Because it will harm other stocks. Let's give you an example. Suppose you choose a $10 stock as a benchmark. So then if you switch to proportional, 1 cent tick size will be 10 basis points. 100 share loss size will be $1,000 loss size. So now, if firm go to $100, then it has a 10 cent tick size and a 10 share lot size. Let's say the firm, the original spread was at the optimal, which is 2 cents. 1 cent from tick constraint and 1 cent from lot constraint. If you make this choice, okay, the proportional tick and lot, now the bid-ask spread becomes like 10.1 cent bid-ask spread. Why? Because you reduce the lot size constraint. So the lot part will reduce by 10 times, but you increase the tick part. So altogether, it's 10.1 cent bid-ask spread. So actually, reverse is true. If you do that to a $1 stocks, the percentage spread will be the same. So why is this interesting intuition? It's because, surprisingly, uniform tick size and lot sizes are more flexible than proportional. Why? Because if we have uniform, it sounds less flexible. It's like one size fits all. But there's still 1 degree of freedom for firms to move. It's like, if you large stocks, you should choose a high price to remove the tick constraint. Because liquidity is less a constraint, you can maintain a relatively large lot size. If you're a small firm, you should go the reverse. It's like because your percentage spread is high. So even if you choose a low price, you still have a rather wide bid-ask spread. So you are not tick constrained. So that means the perfect system is like what Pete said. It's like a perfect continuous market. This is what we show for, but 1 degree of freedom is better than 0 degree of freedom. Actually, proportional lot and tick sizes are 0 degree of freedom. And
So-
yeah, Pete.
Can I ask you
Chester.
questions?
Yeah, Peter, yeah.
So, Anna Obashayev and I have this paper that's a working paper that's been around for a while, where we're looking at bid-ask spreads and cover a lot of this ground that you cover, including minimum lot size and minimum tick size, and what the optimal kind of optimal values for these things are as a function of the cost of a trade. So are you getting results that are the same as what we got, or are you getting something that's different?
We haven't. This is the early version. We should check with. I'm aware of your paper, but what I should do is like I compare result with the result, see where we have different prediction and we have similar prediction. Yeah.
You should.
So,
Yeah, we cover. It's somewhat different because it's all based on an invariant cost of a trade, and then dimensional analysis. But a lot of your arguments have a dimensional analysis flavor here, but yet I'm not sure that you're getting the same result, because you're thinking about the effect on market liquidity through a kind of kind of ad hoc model of market liquidity, and then we have our ad hoc cost of a trade that is giving us a different, potentially different kind of approach. But I think that we might be coming up with something similar in the end. That in particular, lot size and tick size are both important.
Yeah, thank you. So so let me conclude. So it's like so the first one is for firms. Something I want to say for firms is a firm's optimal price balance two similarly small frictions. They are similar small frictions. So all firms maximize the liquidity at a 2-tick spread. So simple economic intuition after some calculation is like contribution from tick size is equal to contribution from lot size. And we show the magnitude, actually it's not that small. It's like correct split ratio contributes to 95 basis point to the 272 basis point of split announcement return. And a median US stock value would increase by 69 basis point if it moves to optimal price. And the second main takeaway is like a simple formula to calculate the split ratio is bid-ask spread minus 1 tick divided by the tick size. So this is on the uniform tick size, by the way. Okay, and then we have a 3-factor model of liquidity. It explains actually more than 80% of cross-sectional variation in bid-ask spread. So what are the factors? A dollar volume, volatility, and the price. Okay, and for price, because we cannot use price to explain price, so we reduce to 2-factor model, which is dollar volume and volatility explains 61% cross-sectional variation in stock price. And finally, it's like there are different considerations, but we encourage the policymakers to reduce tick and lot sizes, especially for tick and lot binding stocks, respectively. So thank you for your time. I will still be here in case you have any questions.
Thank you very much, Mao. This was really exciting. So we had a lively discussion in the chat. Rather than sifting through the chat to figure out which questions are still unanswered, maybe we can go with raising hands and just asking Mao. There are no hands yet. So Mao, okay, there's one. Bart.
Should I unshare my slides so then people can see more people, right?
Yeah, maybe a good idea.
Yeah. You see all my friends here. See more of them.
Should I go first or?
Yeah, it looks like we're gonna do the time of arrival. So Bart, you first.
Just, go very quickly. So thanks a lot, Mao. So I had this question when you began the model that it seems like the dApps never appear in your liquidity measure because it's all about the spread. And then my understanding, and correct me if I'm wrong, is that essentially you're assuming the liquidity takers always trading round lots, right? So in another way to think about it is you have an implicit assumption that that the depth is essentially always one round lot. Is that the correct understanding? And following that, basically you're ignoring all the odd lots, right, in your model and in the empirics. Would that affect, for example, the measure of your beta spread, because many of the odd lots codes are actually in the displayed the spreads? I wonder if that would affect your empiric analysis. So that's my question.
Okay. About this is a great question. These two are great question. Number one is about the depth. It's like I choose to be brief here. On the continuous benchmark, the depth is always 100 years. So they were not actually that intuition. I believe it's like I see Josh here, and also John Thing is here. It's like that's in their model. It's like if you display more shares, and also in many old models, if you display more shares, the price will be worse. So finally, if I can slice and dice, I only slice to one lot. Second question, that's my other paper. You are right. All lot prices are better. But why we still care about round lot price? Because it's the benchmark for many regulations. For example, it's like Robinhood. We have that discussion. It's like Robinhood can easily beat like 100 share price. But so Sida and my younger student is like Fred Son have another paper showing, yes, Amazon is the proportion of internalization is ridiculous high. It's like a majority of volume actually goes to dark pool internalization because it's easy to beat the round lot price, but still that's a distortion in the market. But yes, people can trade round lot, order lot, and now people can trade a fraction of shares because their beta spread should be lower than the round lot. That also says why we still care about the round lot price, because how we define the regulation is based on round lots. Yeah.
All right, Mina.
Hi. I have a question about the theoretical part.
Yeah.
So in the theoretical part, you assume the form of asymmetric information that arrives, I mean, basically is resolved after trading one lot, correct? So I think that is kind of, I mean, I think that made sense when we thought about like public information arriving in the context of Budishik, Crampton, and Shim. But there may be, other kind of asymmetric information that take longer to kind of be resolved. So even if lot size is very small, and after some informed traders trade against you, it's not like you will automatically learn the true value. You may actually trade many lots until you learn. So in that case, the asymmetric information is kind of, so I think you might be measuring kind of a lower bound of this spread that comes from asymmetric information. And I'm wondering how the kind of allowing for this longer term asymmetric information affects your theoretical result.
Yeah, that's a good question. Let me give a frank answer. In the model part, we thought about that. It's very hard because then if we learn that in the longer term, then we have like a non-staging or a beta spread. Think about Gaussian and Milgram. It's like a beta spread become narrow and narrow, and then we need to calculate what's the mean in this like a non-staging or process. So that's a limitation of our paper. So our paper actually can only speaks to two cases. Number one is like a publicly information. It's like sniping cost. It's like a recent paper by like Eric Budish. Basically, they show it's a important proportion. The second part is like it can be private information. I think you see that too. The only thing is like you need to assume it's like the information is released one period after you trade. That's also a strong assumption for trackability. But I have one defense for that. It's like so because now lots of market maker, not a perfect defense. Lots of market maker now they hold a very short inventory, so they cannot really be adverse select when the position accumulated. They hold a very long, very small position, maybe slightly more than like a one round lot. But they buy and sell during this process, so they cannot be like adverse like multiple times say that. But I agree with you. That's an imperfect defense. Every model is only an approximation. But good news is like surprisingly, empirically, it works extremely well. But we have some caution to interpret that. We didn't say it's like a public information drive our result. It might be like the private information mentioned by you is somewhat correlated with the information structure we model, so that we can have great cross-sectional predictions. But definitely, it's like a not being able to incorporate like a traditional like long-term information. It's a limitation of our model.
Actually,
Yeah,
I have.
I mean, I thought the.
Yes.
Yeah.
Oh yeah, I thought the empirical results were actually very interesting. So I think I was wondering how empirical results can capture so much given the simplifying assumption. So I think that your volatility captures like a kind of a more kind of fuller asymmetric information, and I think that's why. So, but I think there are some other results that you actually compare the optimal, like the firms that do split with optimally versus not. And like, so those results should really strongly depend on the theoretical results. So, I mean, I thought it was interesting. So that might actually give you a little bit of a test to see how restrictive the simplifying assumptions are. But I thought the paper was very interesting.
Thank you.
Yeah, so I just have a quick summary statistics to add is that the modern market makers, you think like those HFTs, their the average time that they flip their sign of their inventory is about 2 or 3 minutes. So essentially, if their inventory horizon is that short, you cannot really adverse select them in a very, very long shot with a very long horizon information. So probably that also adds to the real bid-ask spread setters view, because they only hold that for a very short term period.
But the high frequency traders are not the only ones with private information, right?
Yes, that's true. Yeah. So in our model, yeah. So those HFTs are just the beta spread setters. Of course, there are other people who set the beta spread too.
All right, I think Pete is next.
Oh, let me just start by summarizing what I think I learned from the exchange between Mina and Mal and Sida. And that is that if you think about long-term market impact and trading on long-term information, it probably does have market impact, but that they're not actually picking off or adversely selecting high-frequency traders, because high-frequency traders get out of the positions long before the impact actually happens, because it might be over a period of months. But so that leaves the question on the table of whether the current liquidity is a function of high frequency traders' tendency to be picked off, or alternatively, a function of longer term traders also having price impact over longer horizons and sort of picking off one another over the longer horizon. So I think it's an interesting question that deserves more research. Going to the second point that Mina raised, and that is looking at your regressions to explain the liquidity. Invariance predicts, the invariance theory that Anna Ogajiv and I have predicts that the coefficient should have a ratio of something like the same coefficient on variance that you would get on dollar volume. And then it should be dollar volume that's relevant and not market cap. So you already said that dollar volume is relevant and not market cap. Could you address the question of whether the coefficients line up the way invariance predicts with the same coefficient on variance as you have on dollar volume, which is kind of, we did some somewhat similar regressions, not controlling for the tick size in the earlier version of our paper on spreads. But when you do control for tick size, I think it might be somewhat different. I mean, we're working on that now.
Okay. Sida, you want to say something, or you want?
Yes. So I think the question is on it's on the coefficient of the trading volume, right? So essentially it's slightly less than 1, not exactly 1. Instead, So why is the volume? Is that the question? Sorry.
Well, the question is if you put log of bid-ask spread on the left-hand side of the regression and adjust it for your, your extra tick from the discreteness, then on the right-hand side of the question, you put log of dollar volume and log of volatility measured some way. The coefficients on the right-hand side on log of dollar volume should be the same as the coefficient on log of return variance. So if you put standard deviation there, it would be 2-to-1 ratio. That's what invariance predicts.
We will check that. Yeah, we haven't. Yeah.
All right, and
Thank you.
then okay, and then Marcus.
Okay, hi Mao. So
Hi, Marcus.
yeah, so could you adapt your model, and thanks for the excellent presentation, could you adapt your model to futures, in which case you don't have the firm, but the exchange is the main interested party in, let's say, revenue? The more trading there is in futures, the more the exchange makes, but there is no firm to decide on anything, just the exchange. How would that model work on that?
Oh, we haven't sort of futures we were thought about, but there's something similar. It's like we have think of ETFs actually. We think that matters a lot for ETFs. So because two ETFs have the same fundamentals, so they should have a higher incentive to choose the correct price. Because let's say we have two like ETFs for tracking SP 500, you have very limited control over everything else. You cannot affect like the 500 other firms. There are two things you can control. Number one is to set nominal price. This is how one ETF can defeat the other ETF. The other thing actually is Sida's job market paper is like, how do you execute your trades during market when you try to rebalance the portfolio? Yeah. For futures, I think it's something in similar flavor. It's like they should choose the right price, but we haven't think about that before. Thank you for a great question.
Yes,
but you know, mechanism is the same, right? Oh wait, it's the same. Yeah. If you design two index, I see your point. If you design two SP 500 futures, like E-mini and the big contract.
A normal size, yes. So there is a lot of example. We can see a lot of examples of, let's say, normal sized and mini-sized futures, in which the choice of the lot size and the tick size can be different, and so therefore they could be a good example to test our model, I think.
Yes. It's a good place to test our model. And also we find the other one actually is, that's a slightly complexity, is Berk-Hashway. So if you talk about design price, it's like there are A shares and B shares. Actually, the B shares is like two ticks. So Warren Buffett must be I don't need to say he must be. He's a smart guy. Everybody agree probably. It's like the slight complexity is like the A shares serve for other purposes. So that also explains why our model cannot explain everything, because when you design a contract, ETF is slightly different. It's like they try to beat another ETFs. But for stocks, for futures, futures probably is more similar to ETFs. I agree with you. It's a good place to test our model.
Yes. Thank you very much for the presentation.
Pete?
Yeah, I've got yet another question related to the previous point about ETFs. So my casual observation is some ETFs are designed to have maximum liquidity. You know, like Spider, they're trying to get order flow from the futures market or from other liquid ETFs. And other ETFs are designed to kind of be illiquid and to exploit the naivete of retail investors. So an interesting exercise for you to do is to see, I think your theory would predict that the ETFs that are competing for liquidity and trying to be liquid, they should have an optimal tick size. But the ETFs that are not trying to be the most liquid, but are trying to exploit the retail investors, they should have a tick size that's too big. And that is something that you guys could easily test as a kind of theory of ETFs.
Yeah. Yeah, we can test that. And also, Sida's your market paper also show there's some ETF don't care. This just design something and thing when they, it's like we can call that sort of agency issues. They design, they don't care about that. Yeah.
Well, maybe they do
But
care. Maybe they want the tick size to be big. I
You're right.
doubt
You're right.
if, you know, maybe you don't have these that have tick sizes too small. I don't know.
I see. So there are 3 types. Yeah, we learn from you. It's like so they're trying to maximize liquidity. There are something. So there's someone who we think is like they don't care. Actually, they care about something else. That's your point, right? Yeah. Thank you.
So it looks like we've run out of hands, which I hope means that I can ask a couple of questions too, Mao, if you're still willing to take questions.
Sure.
So I have 2 questions on the empirical part. In the presentation, you mentioned that the model predicts that some firms should be reverse splitting. I'm curious how often that prediction actually comes true, because firms don't like to do that. Reverse splits are generally considered to be a bad thing, right? So have you looked at how many times the empirics matched theory in that sense?
Oh, Andrew, thank you for the reminder. That's the reason we actually only focus on splits. I should be more clear in my presentation. I write that on the slides, but I didn't mention this, like we exclude reverse splits. Because reverse splits is the major reason. It's like some firm move below like $1. It's like that's a major driver. And also lots of firms think, we talk with some CEOs. It's like some firms think reverse split is something bad for lots of reasons. But what we show is like they should, especially when they went on a very low price. So here's what happens. It's like lots of firms with low price. It's like they start with high price and then the price move lower, and a lower price. So and never revert. So our suggestion is like these firms should reverse split to maximize liquidity because anyway your fundamental value is there. You cannot improve your fundamental value, but reverse split can benefit you. But there are lots of it. It's like a car company. So it's like they suffer from previous all kinds of shocks. So they have very low price, always like a 1 cent bid ask spread, infinite depths. We actually have Ford and GM as another example. It's like and then you can look at their liquidity actually also follow the square rule. It's like the one with higher price is more liquid. But what we show is like they should do reverse split. But I agree with you. It's like the cost of split is very low. It's like there's some cost. For example, how many shares you. So some exchanges charge more money if you list more shares. But the cost is low. Reverse split, there are lots of other frictions. So our model actually have not overcome this friction, this larger friction yet. So the prediction is mainly at the splits. Yeah.
Okay. And one more quick question. So the number of splits has fallen off a cliff in the 21st century, right? There used to be hundreds of them per year. And now I think the numbers are quite a bit low. Is there anything the model can say about that?
Yes, exactly. It's because algorithm trading effectively reduces the lot size, because now you can split like into 100 shares, almost exactly. Before that, if you think about the manual market, you cannot do that. Think about a famous example by like Barclay and Warner. It's like at that point you cannot do that. So actually our paper can explain why there are less splits, because of this natural trend of the effective lot size becomes smaller. So you need less, you have less incentive to split stocks if people can trade it more easily. Institutions think about 100 shares. Yeah, that actually is it's very consistent with the trend. Is like stock price increase, there are less space.
Okay, one more question, Anne.
Yeah, so I hope people have sort of the patience to stick around a little bit longer. So sorry if I'm dragging this out, but I just had a quick question about, in the beginning of your talk, you talk a lot about how it would be optimal to have a spread of about 2 ticks. And I'm just curious about, does that mean then that the optimal tick size is then 2 cents? Because that would be surprising to me. Or do you have a prediction of what an optimal tick size would then be?
That's a great question. It's like I actually was interviewed by the plan by NASDAQ called intellectual intelligent tick. Basically, it's like they have different tick size for different stocks. Our model cannot imply that. Actually, in our model, as I just questioned to Pete, is like the optimal tick size actually is continuous. Let's say if you see a stock currently at 2 cents, you set a 2 cent tick, you only increase the spread. And surprisingly, that's a vicious cycle. And then you can see even wider spread because you increase the constraint, the spread should be higher. And that one actually we caution that interpretation. It's like if you see it's so intellectual tech basically is like you observe current bid-ask spread and then you set tick size based on that that current bid-ask spread. But what our model can show is like then you can end up in a vicious cycle. You increase the tick size, spread wider. Next time you set an even wider tick size, and then the spread becomes even wider. So in our small model, the best tick size actually is continuous. Yeah.
Cool. Thanks.
All right. Well, it looks like there are no more questions. Mao, thank you so much, and Sida as well to you for answering questions in the chat. I think this is it for today. And next week, same time, we are going to have a very interesting paper about order management with machine learning. So hopefully all of you can make it back in about a week. And see you then.